So you want to buy a house. The first thing you need to do is get pre-approved. What is a pre-approval? A pre-approval is when you reach out to a lender and they start the process of looking into your financials. We're going to look to see what you do for income. We're going to see what kind of debt you have. We're going to see what your credit score is. And all of these factors go into figuring out, can we get you pre-approved? And if so, for how much money?
Absolutely. So step one is call mortgage company, give them your personal information. They're going to need your name, address, date of birth, social security number, what you do for work, how long you've been on your job, what you're making. Okay, the biggest thing the mortgage company is looking at is your monthly income versus your monthly debt. Okay, that's how we calculate your debt to income ratios. All right, your debt to income ratio is going to impact what loan program you can do and how much you can borrow.
So the first thing we're going to do is we're going to run your credit. We're going to see what your score is. We need to make sure you have a certain minimum score. On the credit report, we're also looking to see how much monthly debt you have. So your monthly debt's going to be car payments, credit cards, student loans. And we're not looking for the total monthly debt. We're looking for the amount you actually are obligated to pay each month. So if you have a $10,000 car balance, but you're only paying $500 a month, we use $500 a month as your debt to factor into these calculations. So let's give a quick example. Let's say you're making $60,000 a year of income. That means your monthly income is $5,000. Every single mortgage program has a different rule for how high you can go in that debt to income ratio. A good rule of thumb is about 50% of your gross monthly income compared to your gross monthly debt is the amount you'll get approved for. So in this example, if your monthly income is $5,000, that means you can have a total monthly debt of $2,500. That $2,500 has to include your current debts on your credit report plus the new mortgage expense. So a good rule of thumb is about 3 to 4 times your income is how much of a loan you're going to get approved for. Now, everyone's different. Everyone has different debts. Your down payment's going to factor into this, how high the property taxes are on the purchase, of the property you're looking to purchase. So definitely want to speak to a lender and they can customize a plan for you and figure out exactly how much money you'll get approved for.